Advisors, what you're about to see now is really a role play of the entire sales process, steps 1 through 6. We want to show it to you in one continuous role play so you get the feel for how these different parts weave together. We're going to pre-select for you a particular disturbing track, and it's what in our process we call disturbing track number 3. It's about having too much money in the stock market. And the reason that I'm using this disturbing track is quite simple. It is the disturbing track that you're going to use, I would guess, about 80% of the time. Okay? We're going to come back later on in the videos and show you the other 8 disturbing tracks that exist. All right? So right now we're just going to isolate it with that one, too much money in the stock market. I want to give you the fact pattern for this particular prospect and what we're going to be doing. To keep the numbers simple, we're using a $1 million invested net worth. They're going to have $600,000 with one advisor, and they're going to have $400,000 with another advisor. Okay? And therefore, you know that this is going to be a multiple advisor prospect. Now, one of the interesting things when you go through this disturbing track number 3, too much money in the stock market, is that you need to be able to talk to them and ask them 3 very important questions. Question number 1, are you a conservative or aggressive investor? Question number 2, as a conservative or aggressive investor, whatever they tell you, what percentage of your money do you think you should have in the stock market? And question number 3, what's your opinion of the stock market in the future? Do you think it's going to do well or perhaps do poorly? Those questions present really the essence of judo instead of karate. The idea is to hope that you get favorable answers from these prospects. And of course, the most favorable answer would be, I'm a conservative investor. I think I should only have a very low percentage of my money in the stock market. And number 3, I think the stock market's going to be stuck in the muck for a while. It's not going to do well. Okay? My hope is I get those 3 answers, or at least 2 out of the 3. If I don't get at least 2 out of the 3 answers that I want to hear, then I know I've got some work to do. And I've got to try to entice this prospect to change their answers. So in our role play, we're going to give you answers that are not quite as favorable. We're going to have somebody come back with more difficult and challenging answers because I want you to see how to overcome that. Okay? And the one thing I do want to stress, though, is when you start to talk about stock market history and why you think that the person should have a low percentage in the stock market, it almost doesn't matter which answers they give you. One way or another, you still have to go through stock market history. Even if they give you the most favorable answers, that they're conservative and they want to have a low percentage in the market, and they think the market's going to be struggling for the next several years, even then you still need to go through the rendition of stock market history, or at least an abbreviated version. You don't want to take that first answer at face value. But in the role play that you're about to see, you're actually going to see where I need to use that stock market history as a tool to try to get this fellow to change answers. Because if I cannot get him to change answers and get at least 2 favorable answers out of the 3, then what that means is I've got a garbage pail. If after I go through stock market history and my entire explanation, if they still say they're aggressive, they want to have a high percentage in the market, and they think the market's going to do great, then I've got a garbage pail. I need to walk away. Or maybe I need to pivot to another disturbing track if there's another disturbing track that I could move into. Last thing I want to say before we get into the role play is that for simplicity today, the role play that you're going to see is with a single prospect, a single male. But I want you to know that if you have 2 prospects sitting here, a husband and a wife, it's important to ask these 3 questions to both spouses and to get separate answers from both spouses. Because sometimes one spouse might be more conservative and give you the answers you want to hear, and the other spouse might give you answers that maybe you don't want to hear, that are less favorable. And I want to increase the chances of having somebody give me the favorable answers, the answers that I want to hear. And that's why it's so important that you ask the question separately for both spouses. And I also recommend that if you're going to do that, you want to make sure that you ask the what I would call the weaker spouse first, the one with the weaker personality. Because sometimes if you ask the stronger personality spouse first, they'll give you an answer, and then when you ask the weaker spouse secondarily, you're going to get probably just a repeat of the stronger spouse's answer. So I think you should, it's very important that you ask the weaker spouse first, get their answer, their pure answer, and then go to the stronger spouse. Now, Steve, I notice here that you have your invested assets, your liquid assets, divided into two different accounts. You've got about $600,000 that's with one advisor, and you've got about $400,000 that's with another advisor. How long have you worked with each advisor?
Well, the advisor that has the smaller account I've worked with for about 10 years now, and the other one about 5 or 6.
Okay, so the larger account actually you've worked with for a shorter period of time.
That's right. It was all actually in my 401k, and I just wasn't happy after I rolled it out how it was going, so I decided to give this other guy a chance to see what he could do.
Okay. All right. Now, how do you act, how do you work with both of those advisors? Do you call them with ideas and run things by them and they respond, or do they call you with ideas? I mean, what's your relationship like?
Mostly they call me. Once in a while, if I feel very strongly about an investment, I'll call them and talk it over. But usually I'll go with what their recommendation is.
Okay, now do you, so both of them you go with most of the time when they make a recommendation?
Most of the time,
Okay.
of the time. The one that has the 400,000, we don't talk much. It pretty much stays where it is. I do more with the other advisor.
Okay, the newer advisor.
That's correct.
All right, so basically, the $600,000 advisor is a little more active. The $400,000 advisor is a little bit less active, it sounds like.
Yeah,
Okay,
that's right.
okay, all right. Now, I'd like to ask you to rank your two advisors. Tell me whom you think is doing the best job and whom you think is doing the lesser job between the two. How would you rank them?
I'm not really sure. I'd rather rank one over the other. They're both pretty good advisors. You know,
Okay.
I'm not sure when you say rank them as to how they've done financially or how I like them.
Yeah, which one do you think is doing a better job versus which one do you think is doing a lesser job? How would you rank them against each other that way?
Well, because I moved some of the money used to all be with the one that only has the 400,000 now. I guess I'd have to say I like the other advisor. I've left a larger portion of money with him, so just by virtue of the fact that he's handling more of my portfolio, I guess I'd have to rank him number one.
Okay, so the newer advisor you think is actually doing a better job. Even though you don't have quite as much of a track record with him, you think he's doing better.
Yeah, he's got a little more diversity inside that account after we talked a little bit about my, when I retired and my different needs. So, yeah, I guess I'd have to go with him.
Okay, great, good. Now, advisors, I want to just point something out to you that I've done here. With every single multiple advisor prospect that you come across, it's extremely important that you ask them the question that I just asked Steve, role playing. Please rank your advisors. Whom do you like the best? Whom do you like the least? For simplicity, we're just using two advisors here. Sometimes people have 4 or 5 advisors, in which case you want to find out whom they like the best, whom they like the second best, whom they like the third best, and so on and so forth. It's extremely important. I also want to stress to you that if you don't get an answer and they say, well, I'm not really sure, that's why I'm here, to see what you think, you still want to push them for an answer. I might say something like this. Okay, Steve, but let's say that there were a law that was just passed that says you can only have one advisor. You can no longer have 2. You have to terminate the relationship with one and move all your assets over to the other. If that law were to exist, just hypothetically, which advisor would you choose? Okay. Push them to get an answer. Extremely important. Now, the next thing that you're going to see here is that I'm going to ask Steve those three most important questions that are the beginning of disturbing track number 3. In the same way, you want to push him for an answer. If your prospect is not giving you an answer, if you ask them what percentage that you should have in the market and they don't want to give you an answer, you need to push them. And you'll see how we do that right now. Steve, I'd like to ask you a few questions. And all I'm looking for here really is a gut instinct answer, okay, to get a feel for where your mindset is coming into this meeting. First question, would you consider yourself to be a more conservative or a more aggressive investor?
I guess I'd consider myself to be more aggressive.
More aggressive?
Yep.
Okay.
I like the stock market. It's been done well by me.
Okay, all right. Steve, I'd like to ask you a second question. And once again, I'm just looking for a gut instinct answer. As a reasonably aggressive investor in your early or mid-60s on the brink of retirement, what percentage of your money do you think you should have in the stock market versus more conservative stuff? And when I say stock market, I want you to know I mean both individual stocks as well as stock mutual funds. How would you answer that question?
Gee, I'm not really sure. That's why I'm here.
Okay, all right. And you know, Steve, I am going to tell you what I think. Absolutely. I'm going to tell you exactly what I think and why. But before I do that, I'm just trying to get a feel for your mindset coming into this meeting. And you know, all I'm looking for is really a gut instinct answer. And in fact, I would say that if you thought about it for more than 5 seconds, you probably thought too long. So you must have a number in your mind somewhere. I mean, help me out. What do you think? What makes sense? What percentage you think makes sense to have in the market? Is it more than 50% or less than 50% as a reasonably aggressive investor where you are in your life?
I'd say more than 50%, if you put it that way.
Okay, all right. Do you think it's more than 75% or less than 75%? What would you tell me? You must have a number in your mind that you're thinking about. What would that number be?
Well, above or below 75%. That's what you want to know? I guess below. And going over 75% might be a little heavy, so I guess below 75.
All right, so what do you think is a reasonable number then?
Well, we're
Maybe
between 50 and 75, so...
Maybe 60 to 70%, somewhere in there. Is that kind of what you're thinking?
That's about right, yeah. Okay, that's about right.
Now, Steve, you said 60 to 70% is a reasonable range. And you also said that you're a little bit aggressive. I would say, you know, I've had a lot of aggressive folks come in here who said they should have all their money in the stock market, so they're aggressive. At 60 to 70%, it seems like you're maybe moderate, or perhaps maybe you were more aggressive in the past, but now you're thinking, gee, as you approach retirement, you shouldn't be quite as aggressive. I mean, do you think you're really more aggressive, or do you think you're more moderate? What are your thoughts?
Well, I have been thinking about it and read a lot of things that say when you retire, you should get a little less aggressive. So maybe I'm more towards the moderate side.
Okay. So it sounds like you're almost wrestling with yourself a little bit, as though you're basically a more aggressive person. You've been more aggressive, but now you're struggling with it because part of your brain knows that maybe you shouldn't be as aggressive because you're so close to retirement, but yet you still have that gut instinct to be aggressive because it's who you are. Does that sound like what you're going through, what you're thinking in your mind right now?
Yeah, it really does. As I approach retirement, I start thinking more about preserving, and so yeah, I'd say that's an accurate statement.
Okay, all right. Now, I'd like to ask you a third question here, and once again, all I'm really looking for is just a gut instinct answer. Okay.
Okay.
As you know, the 1990s were the best decade we've ever had in the stock market. It was just absolutely phenomenal.
Yep.
And of course, that all ended about 8 years ago when the market hit a peak and started to drop. So if you take a look at what the market's done here over the last 8 years, it's basically done this. The market made about a 50% drop and then a recovery. In fact, as of today, the market is still slightly lower than where it was at the peak from the beginning of the year 2000, 8 years ago. I guess the $64,000 question is what's going to happen next? And right now, there are two schools of thought out there. One school of thought says, well, we think the worst is over. We think, the market's ready for a steady, healthy recovery. Maybe not another incredible market like the 1990s, but the worst is over. The other school of thought says, nah, it's much more likely that we might be stuck in the muck for a while. In other words, we might have more drops and recoveries before we make our permanent recovery. My question for you is really simple. Which of these two scenarios does your gut instinct tell you is more likely?
Well, I don't know which one's more likely, but I'd like to think that it's going to go up and that we're going to be in a recovery so I can make more money, of course.
Okay. So you think, what you're saying is you think the worst is over. You think the worst is over, this big drop occurred, and now we're back and things should be a little steadier from this point forward.
Yeah, that's pretty much what I'm banking on.
Okay. All right, good. Now, advisors, I just want to point out briefly what I've done here. I've asked the three questions. When I asked him what percentage he wanted to have in the market, he didn't really want to give me an answer. But notice how I pushed him to give me an answer. I need to find out where his mindset is coming in. And of course, I was hoping he gave me different answers. I was hoping he was going to say conservative with a low percentage in the market, and he thought the market was going to be stuck in the muck for a while. He gave me three wrong answers, three answers that I don't want to hear. So arguably, this is a very difficult candidate, and we're using this as a case study because once again, if we showed you a simple case with all the favorable answers, you wouldn't be able to learn from it quite as much. Now, I did make a little bit of an effort to overcome the answer aggressive early on. When he said he was aggressive, I wanted to at least talk him down to moderate. And noticing that he said about 60-70% in the market, then I think that moderate answer was a better answer. Now we've got to try to get him to reduce his stock market exposure, to say that 60-70% is too high. I want to try to have him give me a lower number. And I also want him to change his answer, hopefully on the market, to say the market's going to be stuck in the muck for a while. How are we going to do this? Well, we're going to do this by going through the disturbing track about the history of the stock market and hopefully getting him to modify those answers. The key to this, though, is that you need to get permission before you launch into the disturbing track on stock market history. Because if your prospect says that he doesn't think history is going to repeat itself, or that history does repeat itself, then you're wasting your time going into the disturbing track. So watch and see how we go about doing this. Now, Steve, I'd like to ask you a question. Do you believe, generally speaking, that history tends to repeat itself more often than not?
I guess I'd agree with that.
Okay. One of the things that I've found is that sometimes by looking at some of the historical trends in the financial markets, it helps my clients and people like yourself to get better insight as to what might happen with the markets in the future. So I think it might be beneficial to take a few minutes and just talk a little bit about some of those historical trends. Do you think that makes sense?
Yeah, okay.
Okay, all right. What I'd like to do here is first start by talking about the stock market over the long run. Do you happen to know what kind of return the stock market typically earns over a very long period of time?
I've heard 10%.
About 10%. Okay. And the way that 10% works is that's a total return. Usually the dividends are about 2%, and the growth in stocks is about 8%, because the 10% is total. So over time, the growth in the market itself is about 8 percentage points. Does that make sense?
Yeah, okay.
Okay.
Go
What
on with that.
Okay. What I want to do then is I just want to kind of go over through the last century, and I want to share with you some of these trends and how that 8% average growth rate actually occurs. And what I'm going to do is I'm going to make two columns here. The first I'm going to do is I'm going to make bear market columns, and then I'm going to make bull market columns. Okay, and of course, you know, a bear market is a period of time when the stock market's not doing so well, and a bull market's a period of time when the stock market's actually doing very well. You know, the best example of a bull market would be the 1990s, you know, when the market just went almost straight up. Okay, so I'm going to go back toward a little bit earlier on in the century, and if you start off around 1900, what you'd find is that we had a bear market from 1900 to 1917. Okay. Now, let me give you my definition of a bear market. A bear market is a period where the stock market has zero growth, where literally, just like the last 8 years, the market dropped and came back. That's zero growth. Now, granted, you would have still had your dividends, but there's no growth. Okay? So when I'm defining that bear market, I'm saying that's a period that has zero growth. After 1917, we had a pretty good bull market. The bull market went from 1917 to 1929, right through the roaring 20s. And as you probably know from your history books, a lot of people made a lot of money in the stock market in the 1920s. But then, of course, you also know from your history books the market crashed. In 1929. And it took until 1948, by most measures, until the market got back up to where it was again. Okay, so we had a 19-year bear market. And then the market took off after 1948 and did very well until 1966. Okay. And then after 1966, the market started to stutter and it dropped. And didn't make a permanent break above its 1966 level until 1982. And then, of course, the rest is history. The market took off after 1982 and did very well till the year 2000. Steve, let me ask you, are you kind of sort of starting to see a trend here?
Well, according to that, looks like we have bears and bull markets like consecutively, alternately.
Mm-hmm. Sure, sure. And how long is the average trend according to this?
Looks like 15 to 20 years, if I could do basic math.
Yeah, about 15 to 20 years, average. And of course, the last bear market started right here at the peak, which was in the year 2000. So the question becomes, how long do you think that this bear market's going to last based upon this?
Well, we've already had a bounce back up, so, you know, might be over already.
Okay.
I know it goes against your model there, but like the V you showed, I think we've gone past the previous high now, so.
Okay.
I hope, I'm thinking we might be on the way up.
All right. It's also important to realize that when I'm defining a bear market, I'm defining it as the amount of time it takes before the market makes a permanent break above its record high. Sometimes a market will make a temporary break above the previous high just a little bit, and it'll come right back down again. But if it doesn't make a permanent break, that's still a bear market. You know, your average analyst would look at a market like this bottom one, this dotted line, and would say, gee, this is a bear market and this is a bull market. This is a bear market, this is a bull market, and so on and so forth. And that sounds great in theory. I mean, it sounds good from a textbook standpoint. But let me ask you, if the bear markets and bull markets are washing each other out or negating each other, are you making any money?
Not if they're washing each other out, you're not.
That's right. That's right. So what my clients tell me is that my definition of a bear market, the amount of time it takes before the market makes a permanent break above its previous level, my definition of a bear market is more of a real world definition of a bear market. Does that make any sense at all?
Yeah, I can understand the theory behind that, yes.
Okay. And the Dow has recently broken back above its previous record from the year 2000. Okay.
Yep.
But most people know the Dow really is not a great indicator of the stock market. The Dow Jones Industrial Average is really 30 stocks. The best indicator of the stock market, and I don't even mean the tech stocks or the NASDAQ, I just mean the large companies, the best indicator of the market is really the Standard & Poor's 500. It's the S&P 500,
Okay.
which is basically the Fortune 500 companies, the bigger companies. And, the S&P 500, if you look at it, was at 1527, right there. It dropped down to approximately 770 at the drop. Once again, that's almost a 50% drop. And just recently, it got back up over 1,500 again. It got back to 1,550. And then now it's come back down again. Okay. So it actually did get over the previous high, but it didn't make a permanent break over the previous high. In fact, what's really interesting I want to share with you is in a lot of these bear market cycles in history, that's happened. Most noticeably, this one right here, 1966 to 1982. During that period, although it took 16 years for the market to make a permanent break over the previous high, it had several occasions where it got up and either flirted with the previous record or surpassed the previous record, only to come back down again. Okay, so I just want you to know that the fact that the market 8 years into this bear market has gotten back up to the previous high, that's not atypical at all of a bear market. Do you kind of follow that?
I understand what you're saying. You're saying that the market won't make a permanent recovery till 2015 or 20?
Well, according to history, yes. According to history, we should have maybe another decade to go or so.
Okay.
So I guess my question becomes, what is it that caused you to give me the other answer? Why do you think that after 8 years the worst might be over? Do you still think that? Or do you think, as Regis would say, is this your final answer? Do you think you might want to change your answer in light of what we talked about?
Well, I'm not so sure. That's very interesting history and the data there. However, I really believe that we won't have another depression. We put new rules in, and I'm thinking the times are different now. Now we've got more of a global economy, more international stocks mixed in, which are doing pretty well. Technology's come a long way.
Of course it has,
So,
yeah.
I'm thinking to myself that maybe we won't follow the pattern this time.
Okay, so you're thinking this might be the first time it's different, is what you're telling me.
Yeah, I do.
Okay, and quite frankly, you've just given me the two most common answers that I get if somebody tells me that they think that we're going to break the historical trend. So I want to talk to you about those things. I think there's a couple things that you need to realize. Let's talk about the globalization first.
Okay.
We've always had globalized or growing financial markets in terms of geography. When the stock market started arguably back in the 1700s in our country, and actually there's some roots to the stock market all the way back to the 1600s, believe it or not. But when it started back in the 1700s and 1800s, a little bit stronger, back then we were only settled really on the east coast of our country. So the stock market was really, based on the East Coast. As we started to move west, the market started to grow, and we started to create markets in the middle of the country, in the western part of the country, and so on and so forth. Now it just so happens that we've got financial markets in a lot of emerging countries, across Europe and into Asia and Africa and so on and so forth. So historically, the markets have always been growing in terms of geography. In fact, I believe that it's highly likely that maybe 50 years from now, we're going to have a financial market, a stock market up in Mars, where we might have to go to another planet and have a stock market.
That'll be interesting.
And that sounds a little far-fetched, but if you thought that Zimbabwe was going to have a stock market 20 years ago, you probably would have said, that's silly, it's not going to happen. And actually, I'm not even sure Zimbabwe does have a stock market. I'm just throwing that out there as a ridiculous example. But my point is that throughout all of these bear markets in history, there have always been people who believe that it's going to be different this time because the markets are growing. There are more and more investors in different parts of the country or different parts of the world. But yet, despite that, every bear market we've had has been still 15 to 20 years. Do you kind of sort of follow my logic a little bit? You see where I'm saying that?
Well, you've got history behind you, of course. So you asked me if I thought this would be different. I was just giving you my reasoning why I thought it might be different.
Okay. So that's the globalization. Let's talk about technology for a moment. Okay. When we had the bear market from 1900 to 1917, there were a lot of people at that point that thought that the market would recover quickly this time. And the rationale was because we had the railroads. The railroad infrastructure had grown significantly. And people said, well, because we have railroads, now not only can we ship our goods and services to people that are near ports, but now we can stick them on a railroad and we can travel across the country. So now people on the West Coast could buy our goods and services. We have an expanding market. Maybe this is the first time in history the stock market's going to recover sooner. And we had a 17-year bear market. Then, during this bear market, we had the trucking industry. See, remember, at one time, railroads were technology, trucks were technology. So after 1929, there were a lot of people who thought that this time the bear market wouldn't last as long. Because they said, now we have trucks. Now not only do you have to live near a railroad for us to be able to supply our goods and services to you, but now we can take it off the railroad, we can dump it onto a truck, and we could bring it out to the most rural areas. So now all of a sudden we could sell our goods and services to almost everybody. So Dave, with this technology this time, I think this is the first time the stock market's going to recover sooner. And of course we had a 19-year bear market. 66 to 82. How about manufacturing? Think about what happened with manufacturing in the 50s and 60s, how automated things were getting, and we were able to produce goods and services at a faster pace. Well, right here, there are people that said, with that kind of technology, that kind of automation, wow, this has got to be the first time in history the market recovers sooner. And we have a 16-year bear market. Do you kind of see where I'm coming from with this?
Yeah, I can understand that. If the pattern does hold, then you could be right, and we could be in for a longer bear market.
And you see, that's my point. There's always been technology. There's always been globalization, expanding financial markets. That's nothing that's different. And I'd like to just, if I may, politely play devil's advocate with you for just a moment. You've accumulated $1 million of invested assets. You're obviously a very successful guy. You've done a great job. Okay? Well, you don't get to be successful without being optimistic. Typically, pessimists don't accumulate the kind of wealth that you have. Unfortunately, though, sometimes the problem is that with optimism, sometimes optimism can cloud your judgment of realism. And that's the concern that I might have here, because I hear this a lot. You're not alone, but sometimes people want to be optimistic. Like you said, they want to believe that the market's going to go up. They want to believe that their portfolios grow. Of course you want to believe that. But let's face it, you can't will the market to go up. You could be as optimistic as you want, but at the end of the day, if there are more sellers in the market than buyers, the market's going to go down. So what I'd like to ask you more specifically is this. If when you turn on CNBC